I'm the Tax Geek, and here are more of your taxes, oversimplified. In this video, we're going to cover the 10% penalty for early retirement plan withdrawals and how you can possibly avoid this penalty. Anytime you take money out of a tax-deferred retirement plan, such as an IRA or 401k before age 59 and a half, you are usually subject to both income tax plus an additional 10% penalty tax on the distribution. Why? Because the government really wants you to use this money for retirement. Tax-deferred retirement accounts have helped millions of people live a much more financially secure life in their retirement years. Social Security alone is not enough to maintain your pre-retirement lifestyle and was never meant to. Early retirement plan withdrawals can significantly affect your financial future and be costly when you make them. A retirement plan withdrawal is subject to the 10% penalty if the distribution code on Form 1099-R is a 1. To learn more about distribution codes for retirement distributions, you can check out this video in the top right corner of the screen. A link to this video is also in the description. That being said, the IRS has very specific exceptions to the early withdrawal penalty, and we're going to look at what they are and what types of accounts they apply to. The exceptions to the penalty are very specific. The IRS does not recognize any sort of general hardship withdrawal from a retirement plan. Unless the distribution falls under a specific exception, the 10% withdrawal penalty applies. All distributions, unless they are distributions of contributions to a Roth account, are also subject to income tax, regardless of the reason for withdrawal. Some of these exceptions apply only to employer plans such as 401ks, some of the exceptions apply only to IRAs, and some apply to both types of plans. If you're claiming one of the exceptions to an early withdrawal penalty, you must file Form 5329 with your tax return showing the reason for the exception and how much of the withdrawal you're claiming is exempt from the penalty. Here are the codes for the various exceptions. Exception 1. This is called the Early Retirement Rule and applies only to employer plans and not IRAs. If you separate from service from a company in the year you turn 55 or afterward, any distribution from that company's qualified plan after you separate from service is not subject to the 10% penalty. The separation can be either voluntary, such as resignation or retirement, or involuntary, for example layoff or discharge. The age for this exception reduces to 50 for certain public safety employees. Most of the time these distributions are coded 2 on Form 1099-R, and it is unnecessary to claim the exception. Exception 2. If you convert your retirement plan balance into a monthly income you expect to receive for life, those monthly payments are not subject to the 10% penalty. The exception applies both to IRAs and employer plans, but for an employer plan you must have separated from service from the company that offered the plan. Most of the time these distributions are coded 7 on Form 1099-R, and in that case it is unnecessary to claim the exception. Exception 3. If you receive a distribution because of your total and permanent disability, your distribution is not subject to the 10% penalty. This exception applies to both IRAs and employer plans. Most of the time, these distributions are coded 3 on the 1099-R, and it is unnecessary to claim the exception. Exception 4. If you receive a distribution as the result of someone's death, the distribution is not subject to the penalty. Just like Exception 3, this exception applies to both IRAs and employer plans, and are usually coded 4 on the 1099-R, making it unnecessary to file a Form 5329 to claim the exception. Exception 5. You can claim an exception to the 10% penalty to the extent that your unreimbursed medical expenses exceed 10% of your adjusted gross income for that year. It is not necessary for you to be able to deduct the expenses on a Schedule A as long as you have sufficient expenses. For example, Ronald's adjusted gross income was $55,000, including a $15,000 early 401k distribution, and he had medical expenses of $10,000. In this case, we subtract 10% of his adjusted gross income, or $5,500, from the $10,000 distribution, and the remaining $4,500 would be exempt from the early withdrawal penalty. This exception applies to distributions from both employer plans and IRAs. Exception 6. If you receive early employer retirement plan distributions from a former spouse's plan under a domestic relations order, those distributions are not subject to the 10% penalty. The next 3 exceptions are only available for early distributions from IRAs. Exception 7. Distributions up to the amount of health insurance premiums paid while unemployed. Exception 8. Distributions of up to $10,000 of first-time homebuyer expenses. The IRS defines a first-time homebuyer as someone who has not owned a home in the last 3 years. And Exception 9. Distributions up to the amount of qualified higher education expenses for you, your spouse, or your dependents. And these last 2 exceptions apply equally to employer plans and IRAs. Exception 10, if the IRS levies the plan, and finally Exception 11, any distributions made to military reservists serving on active duty for at least 180 days. There are additional circumstances where you can get an exception to the early withdrawal penalties, the most common of which is a distribution that is taken as the result of certain federally declared disasters. In this case, the exception from the penalty is not claimed on Form 5329, but instead on Form 8915. And please keep in mind that even though these exceptions may relieve you of the 10% penalty, you would still owe income tax on all of these distributions. What's more, these distributions increase your adjusted gross income, which can affect your ability to qualify for a number of tax deductions and credits, including earned income credit, education credits, the student loan interest deduction, and a variety of other credits and deductions. Therefore, the best way to avoid penalties for early retirement plan distributions is to simply not make them. For more information on early withdrawal penalties from retirement accounts, check out the links listed in the video description. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. You can direct any questions, comments, or suggestions to the comment space below, or email me at taxesoversimplified@gmail.com. You can also follow me on Twitter at TaxGeekUSA. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.